headlines that we at ET Now will be tracking for you all evening. But the big news maker, of course, today is Shaktikanta Das and his team in the Monetary Policy Committee at the RBI, as they have decided to yet again cut interest rates by 25 basis points. The repo rate has been cut for the 5th straight time. And with this, in the last 1 year, it's been 135 basis points cut in the repo rate. That's really huge. Now, the question, of course, is, and that may be on your minds, how does this really impact me, my wallet, my money? That's what we at ET Now will try to decode. In fact, we worked out a little bit of mathematics as well for you. You have the repo rate that's come in at 5.15%. This has been changed, and automatically the reverse repo as well changes to 4.9%. But that's not so important from a customer perspective. But as a citizen, what should worry you is that 6.1% FY20 GDP estimate. That's been lowered from 6.9% to 6.1%. Inflation. Now, the RBI has said that yes, food inflation is going to perhaps stay a little higher, and maybe only in the winter is when we will see production come back, and hence vegetable prices may ease off a tad bit. But yes, food prices have certainly gone higher, and we did see that in the way onion prices skyrocketed, asking almost 60 rupees per kg. That certainly has pinched a lot of our pockets in the last 1 or 2 odd months. But all in all, inflation is expected to continue to remain benign because core inflation is still lower, and that will completely overshadow any sort of uptick that you may see in food inflation. So there you have it. That's essentially a quick summary of what the RBI has said today. The stance as well remains accommodative. That means there may be some more cuts in the repo rate. But what exactly does this mean at the end of the day? That's what we would like to discuss today on the show. And for that, let me introduce then Abhinav Angirish, founder of investonline.in. Thank you, Abhinav, for joining us. And you know, at the end of the day, that's the question on all our minds, right? That when the government takes a certain action, how does it matter to me? So we've done a little bit of mathematics. This is a very simple SBI Repo Linked Loan in its very plain vanilla format. You know, if you're a salaried employee, and of course it's unrealistic to believe you'll get a home under 35 lakhs. So we've assumed that, you know, you're going to have a home above 30 to 75 lakhs and beyond that. So how does this now make a difference? The RBI repo rate cut make a difference to me if I have taken a loan, be it a personal loan, a car loan or a home loan?
Okay, so like you just said, SBI being the benchmark bank, which we always refer to, was the first one to move to, moving their home loan rates typically linked to the repo rate.
Yeah.
So naturally, with the repo rates coming down by 25 bips, logically, your home loan rates will also come down.
Yeah.
Typically, banks are permitted to move their rates or reduce them or enhance them or do whatever, whether increase them or decrease them once in 3 months. RBI policy happens once in 2 months.
Right.
So for whoever these rates will be revised in the next cycle for State Bank of India customers, will probably have a lower rate of interest for the rest of the period till they again look at moving the rates, whether it's higher or lower or whatever it may be, compared to other banks, as all banks have not really moved to the repo rate kind of a logic, right? So like I said, 135 bips kind of a move in the last 1 year. Between Jan and now, the total change RBI has done is 110 bips. But this effect has not really gone to the consumers, because practically everyone still is linked to the MCLR or marginal cost of their lending rates per se. So yes, this move is good. It will help. Specifically for newer customers who will be taking loans now will get the new rates.
New rates.
But for the existing clients, naturally, whenever there's a revision in the next 3 months or 6 months, whenever the bank decides, is when they will get that benefit too. Or probably if there's another rate cut in the next 2 months and you have a bank which typically changes rates once in 6 months. So your rates will be, further go down altogether in one single go.
So that means if I'm an MCLR customer, if I have taken my loan on MCLR, I would not immediately stand to benefit with this rate cut?
Not necessarily, right?
Okay.
So MCLR is not standard for all the banks, right? Every bank's cost of borrowing changes, right? So their MCLR figures change as well. Then you have the premium attached to that on what they want to charge as a premium or their margin over MCLR. So that's not the same. So that's why if you actually go to see in the last 1 year or so, in private banks per se, they have not reduced rates by more than 20 bips. In actual fact, RBI is insisting to make 110 bips. But I think lately, gradually, they will start moving because now the gap between PSBs and private banks is going to grow dramatically, right? So after today's rate, probably SBI will stand at 8.2.
Yeah.
Compared to
8.4-ish roughly.
yes.
That's
So compared to private banks, still at 8.6 to 8.8.
Okay.
So there's a big gap, and that's huge when you're actually borrowing in multiple
Of
lakhs,
course.
right? So the effective benefit will go probably to State Bank of India kind of banks which are looking at. They're also talking about reducing the premiums, by the
Yeah,
way. So
yeah.
this 8.2 could practically further come down if they reduce this 40 bips to 25 bips. So that comes down to 8.05.
Okay.
So that'll be huge, right? So private banks will also have to move accordingly, and naturally other PSBs and other banks will also start moving because they will have to start competing with the largest bank.
Yeah, of
So
course.
so your car loans reduce, your personal loans also come down dramatically, and so do housing loans, any types of loans, right? It also
Yeah.
affects corporates because corporates tend to borrow as well.
Borrow,
So whether it's cash credit limits or term loans, everything effectively comes down. But see, there's also concern in terms of the economy, right? 2 months back, the stance was at 6.9, and today
Yeah.
at 6.1.
Yeah.
And there's a huge difference, right? So even that's the concern, and that's why the aggressive stand taken by RBI.
So what you're saying is that 5.15, this has of course reduced, but what Abhinav is saying that even this may perhaps reduce.
Yes.
So of course in this case it's above 75 lakhs and hence the premium is a little higher, but
Yes.
that too may reduce, and hence that's the reason why the interest rate may further go down from 8.3%. But of course that is something that we'll have to wait for. Abhinav, are there any riders to this repo linked loan? Are there any sort of riders, or is there straight away a transmission that if today Mr. Das has said that, okay, look, now my repo rate is 5.15%. Does it mean that the banks have to completely pass on this, or are there any riders or conditions? Just to make it
See, so
aware.
like we explained, right? So typically, if you are a repo-linked kind of a home, like housing loan, naturally when the revision has happened, all new customers going effectively tomorrow
Yeah.
will get the benefit of the new rates, right?
Okay.
But for existing customers, so if you see, typically banks do it once in 6 months. They revise rate once in 6 months. So if you're one of those ones, who's taken a loan, let's assume, say a week back, you will get this benefit after 6 months.
Okay.
When they have the revision of rates really happening. So it's not going to happen tomorrow for existing borrowers.
So clearly, I mean, since the mood right now at the RBI is accommodative, that means there may perhaps be more rate cuts. And obviously the economy as well is not doing well. So all the more, it looks like there perhaps could be more rate cuts.
Let's hope for that.
That means if I, let's say, want a loan, it would be in my interest to opt for a repo linked loan, naturally
Absolutely.
speaking. But the question is, what is the eligibility criteria?
So eligibility does not matter in terms of what option you're choosing in terms of a loan, right?
Okay.
The more important thing to see in this is that your when the interest rates are falling,
Yeah.
you tend to benefit a lot because you'll
Obviously.
be getting the benefit immediately, right? Comparatively. But what happens in case interest rates go up as well when they keep rising?
True.
So your planning on your EMI can also change dramatically. Now let's assume that you have like this year we had a cut of 110 bips. Assume next year you have a rise of 110 bips. Your EMIs will rise dramatically.
Yeah.
How do you start budgeting and planning for yourself?
There's a lot of volatility.
There's a lot of
basically,
volatility.
yeah.
So MCLR that way could be more standard and could be giving you more judgment of really what your EMI should be. But yes, so the benefits are there of being in repo rate because practically they'll always be lower than the MCLR comparatively. And yes, they could move higher. But I think it's a new thing for us. But if you see, I think over a period of time, probably this should help us in having lower rates for existing and new borrowers as well.
So, why I asked you about eligibility is because I've read somewhere that your credit score has to be a certain
Absolutely.
Number, and also your income. I think it has to be about 6 lakh rupees. So, if you could correct me on that front, or
So that's true.
Okay.
But this is not really restricted to only repo rates.
Okay.
Right? For any borrower, naturally
You
his
have
CIBIL score, his credit score has to be good, right?
Yeah.
So if you banks would see that if your score is above 700 out of 900, then you're actually a good borrower and you've been paying your credit card bills and other EMIs on time, so you are a good borrower to have that. They are a little flexible right now because naturally there is no credit offtake really happening in terms of there are no real estate sales really picking up, right? So they are really flexible, but I don't think there's much of a difference in terms of eligibility because as long as you can afford to pay a loan, the bank is happy to
give
lend
you
you a
the
loan.
loan. Yeah. Okay. Now the question is, if I am an existing loan, I've taken a loan, whether it's home, car, whatever.
Right.
But let's say I'm on fixed basis, which means let's say it's 9%, I'm paying 9%, till the tenure of the loan.
Right.
The question is, should I shift over to a repo linked?
Okay, so for home loans,
Yeah.
yes, you should because typically there is no pre-closure charges on home loans.
Okay.
So RBI came up with the regulation sometime in June 2012, where they said that if borrowers want to move or they want to foreclose their loans, there should not be any charges. Earlier, if you recall, there used to be 2%, 3% charge depending on how long a loan has been.
Right.
However, that's not true for loan against properties. So if you've taken a loan for home improvement, or you've taken a loan for any other purpose besides a plain vanilla housing loan, then yes, banks do impose foreclosure charges. Same is the case. So if you've taken a car loan, that does not move with your MCLR or your repo rate links and so on. That's the EMI stays standard. So if you close those loans as well, you will have charges. So actually, you should really go back and check what your actual cost is. So banks give you a calculation, right? If you close today, this is the cost to you. But in housing loans being a very long-term contract, typically 15, 20 years, in 25 bips, 50 bips makes a huge difference. And since if there are no charges, yes, you should move. And in like today's day and age, fixed rates don't make sense, right? So you've not really gone above 9.25, 9.5, that too for a very brief period. So rather be in a flexible or a floating rate, which we used to call earlier, MCLR is exactly similar to that, and it moves with the market rate movement, right? So makes sense to move. But yes, if it's for 5 bips, 10 bips, makes no sense. You get 25 bips and over because that substantially make a difference to EMI.
Okay, so we basically should equate the sort of cost that we will be paying to change over that loan from fixed to.
So it's a little bit cumbersome because you start doing paperwork again. But if you're paying well, if your repayments are good, the CIBIL score will reflect that. That means that reflects the other banks are very happy to take you at a better rate, right? So yes, it's a little bit cumbersome, but can be easier if you're a regular and a good paymaster. So
Okay, all right. Well, I think the flip side of all of this, repo is being cut, etc. That's great, but the flip side is the way the fixed deposit rates are falling, right?
Absolutely.
I mean, that's really the flip side. And also, we may say that yes, SBI is one of the lowest, interest rate charges, etc. But
they borrow also
the fixed deposits is just at 6 point. Exactly. So I suppose that's a flip side.
Yes.
But hey, you got to deal with it. Okay, you know what? At this point, we will kickstart Ask the Money Show. This is where we invite all our viewers out there to ask any questions that they may be having on loans, on existing loans, on a loan that they may want to take, even festive loans for that matter, because that certainly is the mood for all of us at ET now. We do have that show as well coming up in a bit. But yeah, this is our Ask the Money Show segment. You can always call in 24990300. Or you can email us. We would prefer calls though, because you can get your answer right away. Let's take our very first question that we have received via email. Davinder Tulpule writes into us saying, how will the change in repo rates impact bank FDs? My fixed deposit is up for renewal. I want to know if I should renew it or probably put it in my ongoing PPF where interest is higher. Speaking of PPF interest, by the way, the small savings schemes were unchanged, which was surprising.
Yes.
Have not been cut since I don't need the money anytime soon. PPF, of course, the biggest drawback is that your money is locked in for a certain period. And yes, I think Abhinav, I suppose it's a surprise gift of sorts from the government that they have left the small scheme savings rates unchanged. I think fair enough. We don't have any other social security scheme. But yeah, we were talking about FDs. How would you advise Davinder?
Like we discussed, right? So the bank FDs now are at 6.5%, which is practically nothing.
Yeah.
Your PPF is still at 7.9, right? So there's a 140 bips of gap. So yes, it logically makes sense to move. In this case, he does not want the money soon. So if you can lock him for that period, great. Please move like immediately. Of course, you have lock-ins as well. Besides that, the upper cap of how much you can invest. So if you have larger sums, then probably PPF is not the product for you, and it may not help you. But in this case, it does because it's a huge gap. And I think you should move. There's no rocket science in telling him that you should not. So, and he does not need the money. So, yeah.
Okay. So, don't renew your FD then, since you also, don't need the money. Yes, go ahead.
I would suggest that if now you're having renewals or FDs coming up in like whichever form, you have to take the long-term view. The point is, investors generally think that a 1 year or a 180-day FD is fine, and they may need the money. The point is, you can always break the FD.
Yeah.
The fear of penalty is so high that people tend to take short-term FDs, which are much less on rates.
Do banks even charge you a penalty? Because
so a lot of banks have started, right? So a lot of banks, so private banks were not charging earlier. They would typically say, okay, if you're breaking the FD in between the tenure, whatever the applicable rate, you'll get that, that rate. But now, because it's become so volatile, in terms of private banks having problems and now cooperative banks and so on, so naturally banks also have to safeguard themselves. Okay. So typically, I think 1% is what they charge. PSBs have always charged. They have never stopped charging. So so there is a penalty involved. So, but I think people should try to probably break up their investments in that case. Probably have some short term, maybe not, if you're not sure. Have some probably for the long term, which you want to keep for retirement or some long term plans, long term goals.
I think one very important is the taxation treatment as well, because a PPF is very tax efficient.
Yes.
You get the ATC benefits plus exempt for interest, exempt when you withdraw as well.
Absolutely.
Very unlikely a fixed deposit, which obviously you will be taxed at the interest that you will get. In fact, the bank will deduct the tax and then pay you the interest. So, it's not even like you have
to pay. They will even deduct tax on the accrued interest for that matter. If you take an accumulator for 5 years, each year you keep paying tax without enjoying the interest.
True. Yeah, exactly. So it's not exactly the most tax effective way. So I think it's a thumbs up for PPF, especially if you don't need the money anytime soon. Okay, let's take up another question, and this is a very interesting one. It's coming in light of the news that we are receiving, especially with respect to cooperative banks. We have Vishwanathan, who has written into us saying that he's a senior citizen from Chennai. He has a total of 3 lakhs with different small finance banks. Would like to check how safe is the investment. 1 lakh rupee deposits each. Again, now small finance banks, I understand the reason why, because I think the interest rates over there are very lucrative, in fact even better than most of the banks. How would you advise Vishwanathan to go about this then?
See, this is similar to if you go back 3 or 4 years when corporate FDs were doing so great, right? So you would typically go and ask in every agent to say, okay, which is the best corporate gives the highest rate of interest, and just go and park your money there. So typically small finance banks, because they have to attract fresh investors coming in, they tend to offer higher rate of interest, and that's why you park the money. Naturally, high risk, high return. But it's advisable, and this is what we recommend to all investors. Please diversify in whatever form of investments here, whether it's FDs or equities or mutual funds. Please diversify, because that's the best thing you can do. If all your eggs are going to be in one basket, you might have a problem. However, Governor Das even suggested today that he will not allow any cooperative bank default, which is a very big statement to make. So I think some relief over the weekend for PSB customers, or PMC customers.
PMC,
but let's hope for the best. But yes, he should diversify is what I would suggest.
Okay, so if this 3 lakh rupees is the only amount that you have, I mean, I'm sure it's not that all, but important, the fact to consider is that this should not be your only corpus. I hope that you have, Mr. Vishwanathan, put your money in other baskets as well, because that's very important. You don't want to be stuck up in a PMC kind of mess. And, that's the reason why a lot of our viewers have been asking us this question, right? So, actually, let me ask you this question, because this is something our viewers have been emailing to us and tweeting to us. How do you know then which cooperative bank is safe? Because there are hundreds of them, right, out there. So how do you know that you should let it be patient, or you should perhaps withdraw your money from cooperative banks? Is there any way to judge a cooperative bank, any parameter with which you can judge them?
See, unless you have the technical skills to do the analysis to understand is great. So you can actually go to RBI site and figure it, what the NPA levels and so on. But how many people can really understand those numbers, right? So when you go and see a PMC kind of a thing, 137 branches, a huge book, why would you even think something can go wrong with them, So whether you go by number of branches and reputation, or you can go and read. So I don't know if they can really understand the technicals. That's why they should approach some experts in like financial advisors to actually go and ask whether it's a good bank or whether it's a good instrument to even invest in. So yes, all these banks have the balance sheets published, and the investors have access.
Website.
And regardless, even they walk into a branch, the branch is supposed to provide them with the annual reports, right? RBI will get every quarter for that matter. So they would know what the bank really is doing. But to really understand them could be difficult. The PMC's case is very different, right, compared to this. Apparently, they didn't declare the actual NPAs, the numbers and so on. So even if you'd have seen the numbers, you would not know. So, no, I think it's a difficult task. You should have a professional or some expert to help you with that.
Okay, all right. As we speak, we've just gotten another email query. Okay, this is a very interesting question. He asks, our viewer writes into us saying, is it better to keep funds in liquid funds or to continue with a fixed deposit? Mr. P. Bobby has written into us right now. He says he's a senior citizen, by the way. Again, quite a interesting question, because liquid FDs right now have as well got the SEBI eye on them. There is a bit of regulation where they can invest, where they cannot invest. So people are worried that may hamper the returns. But anyway, how would you advise Mr. P. Bobby?
See, so liquid funds are very clearly defined now, right? It's the 90-day average holding is what they can have and so on. If you need liquidity, liquid funds still continue to be more tax efficient. B, the completely liquid, funds come to your account in 24 hours. Just that if you have on a Friday, it comes on a Monday.
Yeah.
Basically the next working day. FDs are not as liquid because then you tend to break up on your rates. I think after the IL&FS crisis started and the way SEBIs are looking at all these debt schemes, there's been a lot of correction and a lot of pruning has happened across the portfolios, right? So it makes sense that you actually stay in liquid if you want the money anytime. It gives you a better yield, more tax efficient than FDs. FDs earning interest, they're earning dividends. So yeah, I would say if you need the money for liquidity, stay in liquids. If you have for longer term, move to fixed deposits.
Okay, simple as that. Accessibility of money, that's what you need to judge. And in turn, of course, your own tax bracket as well. If you're in a lower tax bracket and you're fine, then FD is okay. But otherwise, liquid funds are relatively a little more tax efficient. Okay, let's just take on board our last question for today, and we'll have to then wrap it up because we're out of time. Dhanraj Kothari has written into us saying, I want to transfer my existing loan to another bank which has a lower rate of interest currently. So do I need to pay a prepayment penalty? And also, if I need to transfer, do I need to transfer just the principal or with the interest? If that's the case, then my entire loan amount will be huge. So is it advisable to take another loan to foreclose a loan? So essentially refinancing. A bit complicated, but yeah, I'll leave it to your wisdom.
No, it's not actually,
okay.
Because it's not that the principal and the entire interest moves to another bank, right? So you have your principal like amount which is falling month on month. This is called reducing balance method. So it's just a principal amount which typically moves to another bank. One, yes, it makes sense to move. Like I explained earlier, since June 2012, housing loans do not have any foreclosure, no pre-closure charges at all. Unless you've taken a home improvement, which is typically called a loan against property. Or you've borrowed after taking a housing loan. That category of borrowing can have a pre-closure charge. So you need to figure that, one. Two is, you will only move the balance of your principal as of the last date of your EMI. The difference between the date of transfer and moving to another bank, that interest for a few days is what you will pay. Other bank will not take up that balance interest for those days as well. The simple thing, yes, you should. Even if your loan is as your new rate is 25 bips or higher, makes sense to move. Yes, you should move your loan.
Okay, all right, Dhanraj, I hope Abhinav has been able to answer your question. We've got a couple of more queries, but unfortunately, guys, we'll have to wrap it up. Of course, don't worry, we will answer your questions over the course of the coming weeks. Abhinav, thank you then for joining in and simplifying this entire repo rate dilemma that a lot of our viewers may be having when they open the TV channels and newspapers. Well, folks, we will wrap it up in this segment, but don't forget, we have some very interesting content and conversations lined up after this break.